Good evening, ladies and gentlemen. Thank you for joining us on this earnings call for the third quarter of FY18. I hope you've had a chance to go through our press release, our quarter's results, and the investor presentation, which has been uploaded on our website a short while ago. I will talk through our performance highlights for the third quarter of FY18 and related topics. Like in the past, we will then open it up for questions. I also have my colleagues from our management team with me who will also address some of your queries. First, let me give you a brief perspective of the economy and the banking front. In terms of the macro, the slowdown in Indian economy seems to have bottomed out in the last quarter, and many critical indicators have turned around. Some early signs of pickup in business expansion, credit demand, and industrial production are visible now. The economy is still in early and tentative stage of recovery, and it is expected that GDP growth should return to above 7% growth by next fiscal. We expect demand for credit to go up further as the economy picks up. The additional capital flowing into the banking system through the proposed banking recapitalization fund would add to the system's capacity to meet additional demand for credit and concurrently push up growth as well. While some emerging risks in the form of rising oil prices, fiscal uncertainties, and rising bond yields do continue to cloud the outlook, we expect the risks to be contained and growth to improve sequentially in the next couple of years by way of response to cyclical and pent-up demand, as well as structural measures starting to bear results. Now on to our business performance in Q3FY18.
Corporate investment banking. Large corporate.
I want to say that this month marks the culmination of 7 years
corporate
from our
sector
first capital raise, which essentially kick-started our transformation journey under this new team that we have at the bank. Over the last 7 years, we have seen a compounded annual growth rate of 62% per annum for advances and 47% per annum for profit after tax, with net NPA having been less than 1% throughout, irrespective of market conditions from time to time. In this quarter also, we have demonstrated very strong momentum, raising the confidence of the bank to meet its long-term targets. Coming to the quarter, advances grew 38% year-on-year, with wholesale and non-wholesale businesses growing 35% and 43% respectively. Our deposit base continues to see strong growth at 29% year-on-year, led by a CASA growth of 34%. CASA percentage is up from 23.67% in Q2 to 24.03% in this quarter. Our ROA has been steadily improving from 1.08% in FY17 to 1.19% until last quarter, and further to 1.22% in Q318. For this quarter, our net profit increased by 28% to 165 crores over the same period last year. This is after taking a post-tax charge of 4 crores in respect of an additional investment in Utkarsh Microfinance Limited, which is the holding company of Utkarsh Small Finance Bank. This was done in order to maintain our stake at 9.99%, as we consider it as a gainful investment for the bank. Normalized for this, the profit growth for Q3 is 31% over last year and in excess of 169 crores on a PAT basis. Credit cost has been consistently reducing quarter on quarter from 31 basis points in Q118 to 22 basis points in Q218 and further down to 20 basis points in this quarter, and we expect it to further decline in Q4 of this fiscal year. I'm extremely happy with the consistent improvement in our NIM, net interest margin, which has gone up from 3.29% in FY17 to 3.54% in Q118 to 3.74% in Q218 and now stands just under 3.9% in Q318. Our cost-to-income ratio was stable to marginally lower than last quarter at 54%. In other words, a very satisfying progress in every respect. I will briefly discuss our financial and business performance in different segments now. Advances and asset quality. First, our wholesale and non-wholesale segments continue to see strong traction. The split of wholesale and non-wholesale advances is 60-40. In our wholesale book, comprising of corporate and institutional banking, what we call CNIB, and commercial banking, what we call CB, we saw a growth of 35% on the average year-on-year. Within the wholesale business, CNIB grew 35% and CB grew 33% year-on-year. In CIB business, NPAs have increased slightly owing to the addition of one account, about which I will give some details later. In our commercial banking business, i.e. mid-market and SME business, there is significant reduction in NPAs as well as credit costs. As we had touched upon even in our last earnings call, we are seeing growth in our CB business with strong customer acquisition driving both NII and fee income growth. The wholesale book yield for the 9 months period was 8.9%. Previous quarter it was 9.1% as compared to 10% in the equivalent 9-month period last year. There was continued pressure on yields being driven by market competition. We believe that this will abate going forward. We also believe that our wholesale businesses are well set up in terms of capability and capacity to take advantage of the likely uptick in the credit environment. The non-wholesale book. Our non-wholesale book comprising retail assets, earlier referred to as BBB in the past, the DBNFI position, which is development banking and financial inclusion, and agri, in aggregate grew by 43% year-on-year. The yields on this book were relatively stable at 13.3% in the 9-month period of this fiscal year versus 13.47% in the equivalent period last year, in spite of a decline in market interest rates. The retail assets segment, comprising of business loans, which include both secured and unsecured, credit cards, and personal loans, delivered a strong growth of 63% year-on-year. The secured loan contribution in the retail asset book was 58%, compared to 61% in the first half of this year, as the contribution of credit cards grew to 23% of that portfolio instead of 19% previously. The cards business continues to see strong growth, and we added 1.7 lakh incremental cards in the last quarter, taking our card portfolio to over 6.2 lakh cards. Having started this business just about 3.5 years ago, this business is now achieving scale and heading towards the bank becoming a significant market player in the card space. The overall yields in the retail asset segment have improved from 13.96% in H1 to 14.09% in the 9-month period on account of changing mix towards higher yielding assets. The GNP on this book has reduced from 1.49% in the first half to 1.41% in this quarter. However, as the book matures, we expect this to creep up slightly over the next few quarters in line with market benchmarks, which currently range between 1.75 to 2%. This has been factored into our retail asset business plans. Our DBNFI business, comprising of microbanking, MSME, and inclusive finance institutions, saw an overall growth of 31% year-on-year. While microbanking and SME grew by 86% and 105% year-on-year respectively, the IFI business de-grew by 27% year-on-year in line with our guidance in the past few quarters. Essentially because many of these institutions have themselves started becoming small finance banks, and so automatically, we are getting repayments from there. So this is therefore anyway a business that is going to continue to go in this direction. The growth in the microbanking and MSME business was aided by distribution expansion as we started these businesses in 80 more locations 37 microbanking, and 43 MSME locations in this last quarter. We had previously indicated in our last two quarterly calls that GNPA level in this business would peak at 5.5% by the end of this fiscal year. Our GNPA presently is 5.17% as of Q3 FY18 versus 4.67% in the previous quarter. A small residual amount is expected to flow into the next, which is the fourth quarter, thereby ensuring that our peak GNPA level stays within the 5.5% number guided in the last two quarters for the year as a whole. The full credit cost will be contained around the midpoint of our previously indicated FY18 credit cost of between 2 to 2.5%. In other words, we will come somewhere in the midpoint of this previously indicated range. As we complete the provisioning for these loans and write them off during FY19, we expect the GNPA to start coming down sharply to a level of approximately 1% only by next fiscal year end. Furthermore, the portfolio created post-demonetization continues to grow and the portfolio is performing extremely well. We have disbursed around 2,960 crores post-December 2016 and the portfolio performance is at pre-demonetization levels of over 99% collection. Our belief in this market segment is further reinforced with this performance. To take this business to the next level, in recent past, we have invested in terms of geographical diversification as well as product offerings and customer engagement. We are also enhancing our technological capabilities to bring about process efficiencies and enabling our operating model to bank the rural households. Our agri portfolio, which is at 5.4% only of the total bank's advances at under rupees 2,000 crores, our agri portfolio is at 5.4% of the total banking advances and under rupees 2,000 crores. As you all know, this sector has been witnessing some stress in asset quality due to various factors, as already mentioned in previous calls. On account of market conditions, our NPA in this sector, which has historically in the past few years tracked around 1%, are at approximately 2.89% as of this quarter end. In order to control our NPAs in this segment, we are cautious about growing this portfolio and are calibrating our future strategy in the agri business to focus on segments that are more stable and resilient. Our bank level gross NPA, therefore, was at 1.56% in Q3 FY18 and net NPA at 0.97%. I mentioned earlier about one account in the CIB segment. This account, which was under SDR previously, has been classified as NPA in this quarter. This represents 14 basis points or 0.14% of gross advances. We are confident that this account will move out of NPA during the current fourth quarter 2018 itself, and there is a specific resolution process underway which shall be completed within the next few weeks. Therefore, barring this one account, our gross NPA percentage would be at 1.42%, which would actually reflect a decline from the previous quarter and the previous quarter before that. Our restructured assets are at 0.18% only as compared to 0.41%. So this one account which was under SDR earlier has actually, therefore, since it has moved to NPA, that is one account that has moved out of SDR, and one agri account has moved into SDR, and now the total restructured assets stands at 0.18%. Security receipts position was negligible at 0.01%, and there was no ARC sale, no 525 refinancing or S4A case in this quarter. Going forward, outcome of the RBI annual inspection. Our RBI supervision for FY17 concluded in this Q3 FY18 quarter. Basis the RBI supervision report, we have classified the above referred CIB account as NPA. The value was 53 crores, which, as mentioned, we expect to be resolved in Q4 FY18 itself. Besides this, only 2 other accounts aggregating to a small figure of 13 crores have been classified as NPA, included in the numbers already. Now talking about deposits and cost of funds. Our deposit base continues to see healthy growth at 29% Y on Y. The CASA deposits grew 34% during the same period. CASA ratios increased from 23.67% in Q2 to 24.03% this quarter. Within CASA, the savings account growth continues to drive growth, showing an increase of 45% year on year. Our cost of funds has reduced from 6.9% in Q3 FY17 to 6.1% in Q3 FY18 due to the general reduction in market rates, progressive reduction in deposit rates, as well as improvement in CASA. Our cost of deposits has also correspondingly reduced from 6.9% to 6.4% in this quarter. In terms of revenue and margins, revenue growth has seen very strong momentum and has grown at 44% year on year for this quarter. Our net interest income grew 45% for the quarter on a year-on-year basis, and our NIM, which has been showing steady and consistent improvement quarter on quarter since last year, now stands at 3.89% in Q3 FY18. Non-interest revenue, which is other income, grew 42% year on year. Our core fee income growth was 50% year on year for over Q3 FY17. Strong traction continues in our non-interest income, especially in distribution, in credit cards, in client FX income, and general banking fees. Our trading revenue for the quarter was 11% of the total non-interest income or other income, compared to 22% in the first half of the financial year. Our cost-to-income ratio was 54% in Q3, marginally lower than the last quarter. We continue to keep our investment plan for the rest of this year. We added 80 business correspondent branches and approximately 20,000 customer service points in this quarter. We now have a total of 246 branches, 757 business correspondent branches, of which 188 are now classified as banking outlets, and over 100,000 customer service points. Finally, on capital adequacy ratios, our capital adequacy ratio was at 15.03% and Tier 1 capital adequacy ratio was at 13.23% as of December 31st, 2017. This does not include interim profits, as against 15.95% and 13.87% respectively as of the previous quarter end, September 30th, 2017. I conclude my presentation right now. With that, I'll open up the call for questions and answers.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on your touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Thank you. Reminder to the participants, if you have a question, you may press star and 1 on your touchtone telephone. The first question is from the line of MB Mahesh from Kotak Securities. Please go ahead.
Hi, good afternoon to all of you. A couple of questions. One, on the MFI NPLs that you've kind of broadly been indicated, while you've been kind of broadly moving in that direction, are you guys, can you just kind of broadly classify what is it in absolute quantum is the underlying gross NPS today? And have you seen any kind of deterioration in the 0 to 30 day, 30 to 60, 60 to 90, and 90 to 180 as we speak today on the existing stock of those loans out there? And have you, when you factor in, when you're giving your number on the NPLs, are you including the growth rates that you are seeing today, which seems to be reasonably strong as well? That's the first question. Second question is on the mix of savings and current account. You've seen a slightly better growth or slightly stronger growth on the current account side and a slightly weaker growth on the savings account side on a QOQ basis. How should we read into it? It's not a material number, but just kind of directionally understanding as to on the progress of this one. The third question is on the cost side. You've been reasonably slow on the expansion of branches, using most of the BC and other frameworks to kind of reach to a larger customer segment. What is driving this 65% loan growth in OPEX, and how much would be driven by the asset side growth? So essentially we're looking at the DSA charges out there. Thanks.
Thanks, Mahesh. I'll answer the second question, and the first and third, Harjeet will answer, my colleague, who runs the financial and retail asset. So the second question was on the cost of
mix of SBI.
Yeah, the deposits and the mix between current and savings. So firstly, I think it's very important to appreciate that just a few months ago, we raised a fair chunk of capital. We raised 1,680 crores of capital. So actually, even to fund a 40% plus, advances growth, we did not need that much of an incremental deposits. Okay, we use that as an opportunity to bring down the savings rates. Okay, and frankly speaking, despite bringing down quite significantly, we were still able to generate a healthy savings account growth rate. And also, as you yourself remarked, we were able to even improve our current account deposits. So essentially, I would say that that's the way we tried to tackle the situation, and we were able to do that pretty effectively. So that's the answer to your second question.
I'll take the answer.
I just supplement that question. Savings account on absolute basis is down, right, on a QOQ basis? Should we read into it?
No, it's not down. Margins about flat. Yeah. No, you don't need to read much into it.
Sure.
Yeah. We can take it up quite easily.
Okay. And what would be the cost of savings account as we speak today?
Yeah, it's...
Sorry, what's the question?
Cost of savings account.
6.4.
6.4%.
It was 6.7 about a few quarters back.
That's right.
Okay.
That's what I'm trying to tell you, that using that to gradually bring down cost of funds.
Sure.
While having adequate liquidity to fund our growth.
Perfect. Thanks. That's on the savings and current account.
Yeah. Harjeet will answer your other question.
Yeah, Mahesh, your question I think was what is the absolute amount of NPA which is there in the microfinance as of today. So we have a total NPA on our books of about 152 crores. And when we report our NPA percentages, it's a percentage of the book as on that quarter end.
Okay.
So if you recall, when the demonetization had hit, that time the NPAs we had envisaged on that book between 5.5% to about 7.5%, and that is what is kind of turning out as coming through at this moment. Any large-scale recoveries have not really happened in this portfolio in the impacted markets.
Sure. Yeah. And your 90-day DPD last quarter was 4.7.
Yeah, I reported that it was 5.17.
So this time it is 5.17. I think you were referring to the fact that what about the early buckets?
Correct.
Yeah. So
before you continue, 5.17, and as we said it last quarter and before that, this will peak at 5.5. Okay.
5.5. Perfect.
Yeah, we've been saying that throughout. We're sticking to that number. We will manage it within that number.
Sure.
Yeah, and your other question was what is the buckets looking like below the 90 plus range. So our 30 to 90 bucket is a shade below 1% today.
Okay, so that's only not much to be recognized.
So that's not much to be recognized. So basically, whatever had to happen, and that's why we were saying, as kind of flowed, there's only a minor bit which will come in the next quarter, post which the process of the NPA coming down will start.
Perfect.
And your third question was on the
Cost
side, because employees have not gone up, branches are not going up, so the bulk of expenses is being driven by what line item?
Yes.
So about 60 to 63% of the cost increase is driven by the retail assets and cards business volumes. So it's actually variable and linked to that. The rest is BAU.
And that cost is upfront taken.
60 to 63% of 250 crores?
Of the 32 crores increase that we have seen between 2 quarters. Q2 to Q3.
2Q and 3Q? 3Q?
Yes.
Of that?
Yeah.
Sorry, I didn't get the number. You said 60 something, right?
62%.
Of 32 crores.
Oh, pertains to the cards and the... okay.
Retail assets.
Perfect. Done. And sorry, one final question on the corporate loan slippages that you saw this quarter. Can we get a color as to which sector was it pertaining to?
Agri-processing.
Sorry?
Agri-processing.
Agri-processing. Okay, done. Thanks.
Yeah. I know. Yeah.
Mr. M.B. Mahesh, you done with your question?
I'm done. Thanks.
The next question is from the line of Abhishek Murarka from India Infoline. Please go ahead.
Yeah, hello. Good evening.
Good evening.
Yeah, sir, can you, so you said that you were recalibrating the agri piece and, probably you're drawing up a new plan or something. So can you just share what is it that you're changing about that piece and, how things, and also what is specifically the stress area? Is it just the MFI piece or what is it? What else is it in agri?
No. It's not at all MFI or financial inclusion, which has been adequately answered.
Yeah. Sorry, MFI is part of FI. Yeah.
All farmer loans, and some agri-linked, like we talked about agri-processing just now. It's pure agri, okay? And it is where, like we've said again and again repeatedly, after loan waiver and all of that, the kind of moral hazard it's created in the country. I don't want to talk too much about it. We all know that. Okay, I'm talking about that portfolio, which is about 1,900 and a bit total. Yeah. There, as we said, that is the portfolio we're talking about. It's actually just 5% of our total book. Much of that is perfectly fine. Some of that is obviously under stress. And that's what we were referring to. I'll ask Harjit to elaborate.
Yeah. So while we are still going through in terms of which segments do we want to really focus on, I think the underlying philosophy is that segments which have been stable through the last couple of years and have been resilient to the ups and downs, both in terms of monsoons as well as more so in terms of any political disturbances, are the ones which we would want to go after. Retail agri, in a way, kind of qualifies for that, and that is where the entire focus would be.
So what are the products? Is just, what are the products which were there? Was it like, standard crop loan kind of thing, or was it sort of customized products based on certain groups of farmers or something like that?
Yeah, so the product range was full, right from crop loans to rural vehicles to commodities to large value chain companies as well. So we were operating in the full spectrum, and there are pockets where we've seen stress, and therefore that is the recalibration which we are currently undergoing.
So which products or in which states, any particular states where there would be a problem, or any particular products there where do you think there's an issue?
No, I won't say it's states. For example, one or two commodities there has been an issue. There are a couple of value chain large companies where there are issues. The state issue was more in terms of the loan waiver which came in.
Okay.
That we expect to stabilize. For example, in the state of Maharashtra, the loan waiver is now going through, and therefore we are getting the monies back from the government. So that's a question of delayed repayments which will come back. But I think we kind of assessing in terms of, as we want to grow this business, which particular segments would we want to really focus on.
Okay. Thank you.
Thank you.
Thank you. The next question is from the line of Alpesh Mehta from Motilal Oswal Securities. Please go ahead.
Hi, good evening, and congrats for the good set of numbers.
Thank you.
First question is regarding your retail business. If you can give the full breakup of that portfolio in terms of cards, business loans, personal loans, etc.
Okay. Yeah. So
yeah, sure.
No, go ahead. You had a second question.
Second question is related to the margins. Now margins have reached to almost 3.8, 3.9 levels. So where do you see that number stabilizing? Obviously, there is some benefit of capital over the last 2 quarters, but where do you see this number as the portfolio shift is also happening?
So on the second question, the same question when it was put to us in the last 2 quarters, we had said that anything upwards of 3.75, we are sort of happy with, as long as we can maintain a high quality profitable growth in the range that we've been delivering in the past. So that's our so-called, base case, baseline sort of way of dealing with our strategy, So that's what. Now, you yourself said that above 375, there is a few basis points of capital effect, which obviously has been helpful. And I think to some extent, some of the dynamics that I explained has also helped us improve that. I don't see that number coming down in the fourth quarter also. We will hopefully be able to maintain it, around this 3.9 or so, up and down 3-4 basis points here and there, So I think it's a very satisfactory level at which we expect to maintain our business at. And that's where I would sort of leave it.
Yeah, and your question around the contribution in terms of different products and segments within the retail assets. So about half of it is loan against property. Then we have unsecured business loans, which are about 13%. Our cards business contributes about 23%. Another 5% is what we have as working capital to our current account customers, and personal loans at about 6%. And the balance are, loans against fixed deposits, small amount of mortgages, etc.
Just a request, if you guys can give this as a standard disclosure in the presentation, that would be very useful. Secondly,
Sure.
On the Bajaj tie-up, how has been the progress on that front in terms of the number of customers, acquisition? What is the book size out of that tie-up? If you can give some light about that credit card business tie-up, please.
Yeah, so the Bajaj business has been tracking up well. In fact, today, they contribute almost about 42% to our total cards.
It's about 2.5 lakh cards.
Yeah, which is about 2.5 lakh.
The Bajaj part.
Yes.
Is about 2.5 lakh cards.
That's right.
Yeah.
And their contribution.
Total of 6.1 lakh.
6.2 lakhs cards.
2 lakh cards, yeah.
And their contribution to our book in terms of towards the cards book is in the region of about close to 30-odd%.
Okay. And by when do you see this tie-up to break even or turn profitable?
So by this financial year end, we will break even and move into profits.
Okay. And just lastly on the DBNFI business, out of the total credit cost or the NPA provisions we have taken 225 crores, what has been the contribution of just the MFI portfolio in this year?
55, right? 55.
That's the addition to NPAs asking?
Are you provisions you're asking or you're asking?
I'm asking about the provisions. I'm just trying to relate what if there can be any decline in the credit cost.
50 odd crores is towards microfinance.
And there would be some tail left for the fourth quarter, right?
From a provisioning point of view?
Yes.
Yeah, provisioning a little bit will come in fourth quarter, but the majority of the provision of this NPA portfolio will flow into the next year.
Okay, so the total pool at the time of demonetization was around 110-115 crores, is it?
So total, I just said that the total
in the first question, 150.
150 crores is the NPA as of now.
Okay, got it. Thank you so much, and all the best.
Thank you.
Thank you. The next question is from the line of Ravi Singh from Ambit Capital. Please go ahead.
Thanks. My question has been answered. Just a quick clarification. In the fee income growth, the card fees in the distribution or is it fair to say the sharp growth which is in the distribution fee income is led by cards? And how do you see the other line items in the fee income panning out?
So, yes, fee incomes in the distribution side includes cards, and it also includes the third-party products, insurance, mutual funds, etc. And also, and we expect the momentum to continue. In fact, the card side will actually start growing even faster in the future.
Okay, but broadly overall fee income growth has been quite ahead of the overall balance sheet growth. In the future, do you think it should fall in line with the balance sheet growth, or do you see any more reverse kicking in?
Yeah, so directionally, we have always focused on getting more and more revenues from non-balance sheet or non-credit linked sources. And that has worked in our favor. To give you some perspective, last year, FY17, that number was about 32%. Today, that number is 25%. So 7% reduction has happened in credit linked already. And treasury contribution also is around 17-18% of the total other income pie. And when I say treasury, I mean the fixed income securities business, which could have some volatilities.
Okay, thank you.
Thank you. Reminder to the participants, if you have a question, you may press star and 1 on your touchtone telephone. The next question is from the line of Pritesh Bam from Prabhudas Lilladher. Please go ahead.
Hi. The loan growth in the sensitive sectors like construction, power, and some part of engineering as well has been sharp in last few quarters. What is the outlook there, where it is happening from, and are you comfortable with that kind of a growth? That's what I wanted to ask.
Absolutely. From a sectoral perspective, some of this growth has been happening in very select stories, including, for example, the first piece that you picked up, construction. It's largely we are still a working capital focused bank. We are not project financiers or term financiers. We are just in that working capital space in all of these, and these are all highly rated firms in that space.
So will there be any yield pressure in this scenario in these sectors, because all the banks are trying to focus on working capital, high rated corporates? So do you see there?
In theory, yes, but part of it, if you see the exposure that we provided there, it's not all funded. There is a significant portion of non-funded exposure, so where it's not a yield pressure story there.
Okay. Basically, another question was on the cards NPA. So I think we are slowly seeing an inch up in the gross NPA, though the number is very small. So it's about like 1.1% of the cards business. So any sort of trends there why we are seeing such kind of a gross NPA?
Yeah, so in cards, actually, the gross NPAs are coming down. The market typically operates at about anywhere between 1.5 to 1.8%. Part of the reasons why the NPAs are coming down is on account of two factors. One is the fact that as our experience in the cards business grows, our scorecards get that much better, and therefore our origination quality improves. The second is that the NPA on the Bajaj book is expected to be fairly lower than what we have, because that's a credit tested book.
So to clarify, it's come down actually by about 30 basis points.
Yes.
Absolute basis, so it's 15.8 crores to 19.3 crores. It's a small number,
but size of the portfolios. You have to understand that the book is growing by almost 170%. So
it grew by 170%.
Yeah.
So
yeah.
Okay,
almost,
fair enough.
Almost 3 times.
And third question is the growth outlook on growth. I mean, how much growth are you targeting at? So this time it is right now.
20. Line with 20.
You're talking bank as a whole?
Yeah.
Bank as a whole, we have already guided. So that, it's our first slide.
Yeah.
Basically, we are sticking to, like I said in my commentary also, we are very confident of sticking to our long-term, targets that we have indicated of 30-35% CAGR growth and, CASA, other income, operating efficiencies, return ratios, all of that.
Okay, thank you so much.
Thank you. The next question is from the line of Amit Jaswani from Stallion Asset Management. Please go ahead.
Hi, sir. My question is regarding the NPA. You had guided last quarter that our NPAs would be closer to FY17 NPAs. Do you still believe that our NPAs will be closer to FY17 numbers?
We did not guide that at all. FY17, I don't know what that must be. Yeah, I don't think so. In fact, on the contrary, I mean, not that they're going to go up from here. I'm not certainly suggesting that at all. On the contrary, we'll make sure that they are well contained. But I mean, we have come down every quarter, and as I've just said in my earlier commentary, the credit costs are coming down further. But you also have to understand that the mix of our businesses is such that as we are doing more retail and less corporate, actually in terms of the planned level of NPAs as per the business model calculations, technically, there will be a higher proportion of slightly higher yielding, at the same time slightly higher NPA businesses, as Harjeet, my colleague, was just explaining on the retail assets front. So that's the point I was making earlier.
Okay. Right, so that's it from my side.
Thank you.
Thank you. The next question is from the line of Anirban Sarkar from Motilal Oswal. Please go ahead.
Yeah, good evening, sir, and thank you for the opportunity. Just something that I missed from earlier in the call. So you spoke about the divergence details. So am I correct in saying that it's two accounts of 13 crore? One account is 13 crore and the other is the account that was classified as NPA this quarter, which would come to around 52 crore. Is that the right way to read it?
Yeah, first of all, we are not under formal divergence. Let me make it very clear. We were, in terms of the RBI guidelines, we are well within that prescribed percentage tolerance levels.
Sure.
So, therefore, that's the first statement I want to make up front, that we are not under any formal reportable guidance stipulation. Okay? Given our small level of, if I may say, and third is totally there were three accounts. Okay? I mentioned about one specific account of 53 crores, 52.5 crores to be precise, which is what I said is under final resolution, and it is not an NCLT case, it is a regular SDR case which was tending towards looking like becoming an NPA. We have taken it as an NPA, but it is getting resolved, and we are very, very, very confident that within the next 3-4 weeks it should get solved. So that's why I mentioned that in particular separately. Yeah? Other than that, there are two accounts with a total gross value of 13 crores.
All right, okay. Thank you for clearing that up. My second question is on the microfinance book. You mentioned an absolute GNP of 1.52 billion, 152 crores. So I missed the percentage part. What is this as a percentage of the microfinance book?
5.17%.
All right. Okay. Thank you, sir. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Saurabh Dole from Trivantage Capital. Please go ahead.
Yeah. Good evening. My question is about the provisioning coverage ratio. Is there a particular reason that you have allowed it to drop to 52.54% from nearly 60% levels, and are you planning to take it back to 60% in the next couple of quarters?
So, good question. Let me answer it. This one account I keep repeating, is equivalent to little over 4-point-some% of PCR equivalent. Yeah. So, therefore, my point is, even if we had to provide for it on a regular basis, it will be the first level provision. Yeah. So, which will be 15%. But having said that, this will be made up, immediately on the resolution moment of this. That will bring it back to within range, which we have in the past said that it will be, we will maintain between 55 and 60%, which is what we've been saying consistently for the last 12-18 months. So we will be well within that range.
Yeah, because one of the options could have been to maintain the PCR at around 60% and possibly brought down the profit. But in that case...
No. Wait a minute. For what reason? For a running account, your first level provision is only 15%. And it will go out.
No, I was talking about the PCR in the sense that, could you have maintained consistency of PCR around 60%, and whatever then the outcome in terms of the profit naturally would have been, could have remained that. But your PCR would have generally, like, the best-in-class banks, maintain, a tight range of PCRs.
Go ahead.
See, let us explain again. Basically, if you take this one account as a transitory item, given that it is going to get resolved within weeks, really what you're talking about as PCR is 56.5%. Therefore, for a temporary situation, there was no point in taking excess provisioning.
Yeah.
We will go back within the range that we've always targeted to be in.
Okay. Fair enough. The next question is just about the target CASA ratios. Do you think by the end of FY19 we would be closer to somewhere about 27-28% in terms of the ratio?
So again, I'll please refer you back to our long-term guidance under our Vision 2020 goals, where we have said that we will try to improve CASA ratio by 1%, 0.75% to 1% every year. So we started on a base level of 18.6, and that was so the idea was to take it to 24-25% by 2020. Actually, we are tracking to better than that. And yes, we will continue to improve CASA percentage.
Okay, thank you. That's all from my side.
Thank you. The next question is from the line of Priya Singh from Goldcrest Advisors. Please go ahead.
Hello, everybody. I have two very simple questions. I wanted to know what is the strategy you have adopted to motivate your employees to achieve their targets, deliver the results, and what is the employee turnover or the people that you have brought in, which are from outside to achieve the results?
Strategies to motivate the employees. I think all I can say is that we have a highly driven and motivated workforce, and I would say we have the best-in-class management team that exists across the industry. Almost 70% of the bank's employees are stakeholders in terms of coverage of the ESOP program, and as I just reported to you earlier, that we are one bank which over the last 7 years has been the fastest growing bank in the country by far, with profitable prudential growth. Our profitability in year 7 is 48 times the profitability 7 years ago, and every year it has grown, and we have maintained high quality assets throughout with our NPA level net on a net basis never increasing 1%. And every other performance parameter that you evaluate, has been improving steadily and consistently for, several quarters. And market conditions may have been volatile, but our earnings quality, earnings stream, business growth has been non-volatile and improving. So I suggest that I would suggest very strongly that makes for a fairly motivated and committed workforce.
Right. Thank you.
Welcome.
Thank you. Reminder to the participants, if you have a question, you may press star and 1.
Okay, I guess.
Ladies and gentlemen, we now conclude the Q&A session. If you have any further questions, please contact RBL Bank Ltd via email